these are some turbulent times, and through times like this is really when the best opportunities are really there. But we have to understand what we're looking at and have a better understanding of it and have more knowledge to make the right decisions. Going to go into the effect on coronavirus had on interest rates and really why the Fed dropped their fund rate to zero. It has more to do than just the coronavirus. It has a lot to do with oil and stuff that's going on there. So I'm going to talk about that. A little bit about myself. I've been doing this now. It's my 15th year. I was ranked in 2018 as number 64 in the whole nation out of 600,000 loan officers. So definitely take my job serious. This is my career. I'm also an active investor. I have multiple investment properties out in Texas and out here in California. Interest rates before coronavirus and after. So to give you guys an idea, I actually want to show you an 18-month chart, but I'm going to first tell you how to read this graph. So this is the Fannie Mae. This is the 2.5% coupon. It's the most closely traded mortgage-backed security in relation to the loan that you're applying for today. If you're below a 765 loan amount in a high cost market or below 510,000 in a standard market throughout the US. In a mortgage bond, these are traded in billions of dollars, and each bond might be a pool of mortgages, maybe $5 million bundle of those loans, right, with 20% down and these types of FICO scores. And this type of debt is bought and sold on the back end secondary market. The same way that a large investor can go and buy treasury notes, the 10-year treasury note, you're actually buying government debt, right? And then the government's paying you for our U.S. debt. We're the safest economy in the world. So there's a lot of big banks out there and financial institutions that are buying our debt because they believe that we're the least risk of default. But when you buy a note, you're buying debt, right? You're buying the government's debt. When you buy a bond, you're buying a pool of assets. So these assets trade up and down each day in the back end market. Now, green is investors buying the bond. It causes the bond to appreciate, which drives down the yield and makes rates better. Rates go down that day. You know, it's not the other way around. So as this goes up, it doesn't mean that rates are going up. It means they're actually going down. Red is a day when investors were selling the bond, causing the bond to depreciate, which drives up the yield and it makes rates worse. These lines, I want to explain these. The purple line is the 200-day moving average, the average that this has traded over the past 200 days. The pink line is the 100-day moving average. The 50-day moving average is this dark blue line. The light blue line is the 25-day, and the green line is the 10-day moving average. We look at moving averages so that we can get a good idea of the direction of the market. Number one, okay, this is back several months ago. This is back around the end of January, okay? This is back when coronavirus started to become a big deal. It was getting mentioned all over the news. There were people that were, really the scariest part was that around 10% of people that got it were dying. It started to scare people. And at that point, you saw rates get to the best level of all time. Before this, they were great back in August of last year. We had a little bit of worry that the stock market was at all-time highs and that we were seeing month-over-month inflation for wages and GDP growth to start to kind of slow. And it was starting to look like a 2.5% growth rate was going to be hard to keep up with. We were actually at around 3 the year before. Really, we just wanted to be above 2. So it's still good enough, but we were seeing things slow down. Manufacturing sector was slowing down. And so as a result, interest rates got really elevated. Whenever there's lower growth or it looks like the economy is slowing down, interest rates love that. Investors go directly into bonds, right? Causing them to appreciate, driving down the yield, making rates better, right? And usually you might even see stocks moving in the same direction. This used to be inverse. Stocks would go down and bonds would go up because investors would move into bonds. But it doesn't work that way a lot nowadays. Now you have big amounts of credit that can be given to these different institutions where just because they're selling stocks one day doesn't mean that they're going to move right into bonds. They might own stocks off of credit. They might not even be selling. So it's a really different world nowadays. When now you actually kind of see it going back to the old way when whenever stocks would go down, bonds would appreciate. I'm going to talk about, when I get to numbers 4, 5, and 6, we're going to talk about how they're actually both moving in the same direction now and why that's happening. But up until around that point, around August, you were seeing a lot of money kind of start to go back into bonds. And we hit the best rates we've had in a really long time. I was doing like 3 1/4 30-year fix with no points, 3 3/8. 3.5 was easy to get again, which I hadn't seen that in years. So August of 19 was a great time to be getting a loan all the way really through the end of the year. But then number 1 came, and coronavirus was the one thing. The markets, all these economists are looking for what's the next thing that we're going to have that's going to give us a setback to cause, a bear market or put us into some type of a recession. And coronavirus was exactly that. And the market started to get scared, and so we started to elevate. Rates started to get better. We hit the best levels of all time. Then we hit number 2. Trump came on, and he gave, basically just told the markets that coronavirus is definitely a big deal, but it's definitely under control, and there's only 15 people in California that actually have it, and most of them are already better again. And the market didn't really buy it because the market looks at coronavirus as slowed growth. And I think the best opportunities come during these times. I mean, the fact that it's a black swan or an unforeseen situation that's hitting us right now, and we have low rates, has really created such an amazing opportunity. But when the stock market's going down sometimes 3,000 points in a day, oil going down, 30% in a day, it definitely scares people. And it can scare you enough where you don't make any action. And so that's kind of why we want to educate you on this tonight. So again, you can make the right decisions right now in this opportunity world that we're really in. And so again, Trump comes out, doesn't do a very good job of keeping people calm, because immediately we saw it just start to elevate. And really it's because the data started to come in too. We started to see that we're definitely getting slower growth already month over month, just from January and February, right? So then we move up into this elevated range, and then number 3, Fed cuts 50 basis points on their federal fund rate, and it was still at around 1.5% for banks to lend off that money. So still pretty elevated. We were as high as we were 2.75 to 3% back in 2018 when the Fed raised rates 4 times. So we came down a lot, but it was still pretty elevated. So we saw them we saw them cut interest rates, helped mortgage rates to get into this perfect storm, and rates just kept getting better and better and better. Then we get to number 4, and this is not last Monday, but last Sunday, not a couple days ago, but like 10 days ago. I'm at my house and I'm watching Netflix with my wife and just getting some time off and hanging out with her. And I decided when she got up to go to the bathroom, and I decided to put on Bloomberg just because I wanted to see what's going on. And oil prices are down 23%. And I'm going, whoa, what just happened? And what happened was Russia, Saudi Arabia, Saudis wanted Russia to bring their oil prices down, and they couldn't come to an agreement. And Saudi Arabia decided to flood the market with oil. And that's added another layer of what's going on right now on top of this coronavirus. And from that point, when you see oil dropping like that, this is all going to be probably short-lived. What they did was probably considered illegal, and there's going to be a lot to go through over the next few months over this. But the point is that lower oil prices generally lead to lower price of goods, generally lead to slower growth. We already had the slower growth in place because of coronavirus and the impacts we were already seeing. And as a result, you saw interest rates at the best levels of all time on number 4. That was a 3% free loan, primary residence, maybe even a 2.875. And it was very short-lived. It was a few minutes, literally. And then from there, the end of that day, we saw money go in a flight for cash, okay? It wasn't anymore about holding bonds or holding treasury debt. It became, we need cash. some of these junk bonds and trash stocks that investors buy, I mean big investors like BlackRock that they invest in, because it's fun sometimes to bet on some small company that's going through hard times, become a penny stock, but if they have a business plan in place and the economy stays solid, if they come out of it, it could be a massive return. You know, there's a lot of big hedge funds and banks that place those bets, and a lot of times they do that on credit. And so what happened on number 4 is you get such a big drop in the stock market that these institutions, they get margin calls and they have to cover, and cash becomes the biggest thing on the street that's needed. And that's why even when you've got all this stuff going on, Fed that just cut 50, it looks like they're going to cut again soon. You know, it's mortgage-backed securities and treasury notes and any type of investment that day started to get thrashed, and we started to see money move into cash. So let's step back for a minute. On that day, we saw oil tank 30% in one day, tanked about 20 today. We saw the 10-year yield fall to 0.33. Okay, the 10-year treasury note before this whole thing happened, I've never seen it go below 1.46. So it's a really, really big day. You know, this was caused not just by coronavirus. It was caused because of what's going on with oil. Okay, and many could say that oil was already moving into a bear market because of the fact that oil companies need about $50 a barrel oil on average to be profitable, you know, and it's hard to see that we already have a warmer winter, natural gas, and things like oil, they're still running the world, but there's a lot of other different clean energies now that we use. And you've already started to see a little bit of a bear market coming for oil for a while. Well, when the Saudis did that, it just tanks the market, okay? So now let's move on to number 5. Number 5 is when the Fed comes out and they cut rates to 0. So this whole last week, when we saw the best rate of all time, number 4, the whole week we just saw a flight to cash. Stock market would go down 2,000 points. Well, so would the interest rates would also be worsening. And I'm getting calls like, Reed, why aren't rates better? And there's a few reasons, right? One is banks took too many applications and there's not enough liquidity in the secondary market. Okay, the secondary market that buys mortgage-backed securities is not just the Federal Reserve doing it. It's other investors follow what they do. And there just wasn't enough liquidity in the secondary market because of this flight to cash. Okay. The other reason, though, is because the Fed, I think that they kind of knew that they were going to drop it down to 0, because you saw last Friday, you saw that the market got a little bit better, tried to go down below our 50-day moving average, appreciated above it. And then come actually Sunday, we weren't supposed to get an announcement from the Fed until Thursday, which would be tomorrow. We actually got it this past Sunday. Fed didn't want to waste any time. They're like, we're dropping rates to 0. And why they did that, you guys, is because they want banks to pass on help to the consumer, help small businesses, you know, help us get through this black swan that could be a month, 2, or even 3 months long before we see the virus start to taper off, and they can get a better idea of when this is going to end, so they can get a better idea of when companies will start to do better again and quantify all that, and then the markets can all kind of come back. And so again, when the Fed dropped interest rates to 0, it did help out interest rates short term for even mortgage rates, even though it was really done for the entire economy for so many different types of loans. Banks take a beating when things like this happen. And so to keep rates low for them and keep them making money and giving them stimulus, they're going to pass it on to the consumer. If we don't do that, the same thing's going to happen in the opposite direction. They're going to pass it on to the consumer. So number 5 was when the Fed cut rates to 0. And everyone's like, Reed, is my interest rate 0? And I'm like, no, let me explain this to you. You know, so we didn't even get back to the best rates of all time after the Fed cut to 0, believe it or not. You can see it right there. Then the next day, which was yesterday, I was locking loans all in the morning, and we were able to get above the 102.5 right there, and then we sold off beneath it. And then now today, we're back to cash in full effect. It's a flight to cash again today, mainly just because of uncertainty still over coronavirus. And, you know, it's starting to look better. There's some good stimulus coming out. But until we find a point where where the amount of cases is starting to go the opposite direction, or it looks like we have some sort of a handle on this, where, like I said, they can really quantify when it's going to get better again, it's very likely that we will continue to see flight to cash. We will continue to see the stock market have really big ups and really big downswings. It's so important too, if you do own stocks, to just try not to look at it. Don't touch it. I'm not your financial advisor, but I can tell you that this is a strong market that we have. This too shall pass. And when it does, you will see those companies, the really good companies, the strong companies, you're going to see them go right back up again. And again, it's the opportunities that you can find in this market, really real estate wise, with rates this low, that I think you've got to be taking a look at right now.